เข้าสู่การนำเสนอข้อมูลของบริษัท PSL Shipping สำหรับไตรมาส 4แล้วก็สำหรับปี 2019 นะคะโดยคุณคาริด ฮาชิมกรรมการผู้จัดการก็จะนำเสนอข้อมูลในเรื่องของภาพรวมของอุตสาหกรรมและคุณกอตัม คูรานา CFO จะนำเสนอข้อมูลในเรื่องของตัวเลขทางการเงินผลการดำเนินงานและในช่วงท้ายในเรื่องของคำถามคำตอบค่ะขอเชิญคุณคาริดค่ะ
Good morning, everybody. We will, of course, as usual, do the presentation in two parts. In the first part, we will discuss the industry structure, and in the second part, we will look at the financials of the company. So if you look at this slide, it shows you that the trend line for the tops of the market remain unbroken, and it therefore appears that the trend should continue. The only thing is that you see also that the drop this year has been far sharper than the previous year, and I'll explain why that is so. Now, if you look at this slide, here what we're trying to show you is what has happened to the Capesize sector during 2019 and up to the start of the 2nd of January 2020. So in this slide, what do you see? You see that the first item that we have marked out for you is the 25th of January, when there was the mining disaster in Brazil, where about 270 people lost their lives when a tailing dam from the mine collapsed and washed away one whole village. As a result of that, the judiciary in Brazil closed down all the southern mines of Vale, and that removed about 90 million tons of iron ore capacity from the export market. At the same time, Australia was having very bad weather, and there were two back-to-back cyclones, one starting out, Veronica and Wallace, one starting out on the 18th of April, and the second one on the 18th of March, and the other one on the 16th of April. As a result of that, the rates went from $13,300 on the 25th of Jan all the way down to $3,460 per day per ship on the 2nd of April. Now, when the markets collapsed in this spectacular fashion, what did the owners do? If you look at the top part of the slide, they took two actions. The first action you see is that they scrapped more ships during the first half of 2019 than they did in all of 2018. And the second thing they did, and this is far more important, the second thing that they did was that they reduced the speed of ships by about 6% to 10.3 knots. When you reduce the speed of ships, what do? You basically reduce the size of the operating fleet, and therefore you reduce the supply of available ships. As a result of these two actions, you can see that by the 3rd of June, that is in another 2 months' time, the rates went back up all the way from 3,460 all the way back to 13,300. Now, at this stage, though Vale's mining, the southern mines were still closed, but at this stage, Australia had come back and was exporting in a normalized way. So rates started to continue to go up. And on the 25th of June, when the rates had reached 18,500, the Brazil's judiciary opened up the single largest mine in the southern part, which had a 30 million ton annual capacity for exports. And as a result, you can see that the rates went up all the way to the 4th of September when they reached $38,000 a day. Now, at that moment in time, what did the owners do? When you're earning so much money, you start to speed up your ships. And so if you look at that point, we have made a remark over there saying that vessel speeds increased by almost 11%, which from the bottom, which means that now you're adding about 11% more supply of ships. And as a result of that, the rates started to fall. But the fall this time has been far sharper than the fall in the previous year. So like if you look at the first half of the slide, it's not as sharp, the fall, but here the fall has been sharper still. Now, In the same time, during this 1 year period, what has happened in the Capesize sector in terms of overall supply? Overall supply has increased by 4%. So remember, this 4% is coming throughout the year, and the full impact of that would be felt from the 1st of January of 2020. So what are the factors that have pushed the market further down? So the first factor, of course, is that the Western New Year and the Eastern New Year have coincided into the month of January. So it slowed down January in a bigger way than normal. The second thing was that in the month of January, Brazil had more rain than they've had in the last 100 years. As a result, Brazil exported 34% less iron ore in this January as compared to last January. And remember, last January already had the effect of the mining disaster. So it was a low base, and yet we had a 34% fall in this January. Similarly, if you look at Australia, cyclonic weather has reduced the export capability by 11%. In the meantime, the overall increase of about 4% of the new ships, of the net increase in supply in the Capesize sector, is going to impact the market for the whole of this year. This year, in the first quarter, almost 5.55 million deadweight tons of Capesizes are expected to be delivered, and they will start in a bigger way in January than in other months. And then, of course, you had the novel coronavirus or COVID-19 impacting supply chain logistics in China. So what is the impact of that? Some ships are being banned from other ports after calling China, because they say that you need to be away from us for at least 14 days, and then we will come on board and inspect your staff on your ship to see whether they're all right, and then we will only allow your ships to come into port. Then you've got the famous Diamond Princess, and that is a classical case study for how not to do things and how badly the Japanese government have performed. When a ship which is containing 3,700 people in all has even 1 or 2 cases of infectious disease, the best thing you can do is to evacuate the ship fully. Get the people out, put them into a big holding place. The people who are sick to be sent to hospital. The people who are not sick to wait in like a quarantine area for 14 days. And then once they pass the test, you let them go. Instead of that, what did they do? They kept the people on the ship. And if you keep the people on the ship, the air conditioning system, just like in this room, is a centralized air conditioning system. And if there is a virus here, it's going to go to all the rooms on this floor. And that's what's happening on the Diamond Princess. Finally, people have got their act together in Japan, and now they're evacuating the ship. But again, here, now look at the way they're doing this. It's so silly. The people come off, you find out, say, let's say this half of the room is full of coronavirus. That half is free. But what do? You put them all in the same plane and take them to America or wherever they're going. And now, the people who've got it will infect the others on the plane. All the plane people will arrive there. And because it's a long journey, it's about 18, 20 hours of flying. And then they will reach there, and then they will infect everyone over there. This is just crazy, So the Diamond Princess, I'm sure in future, will become a great case study on infectious diseases and how not to handle a situation like this. The Westerdam cruise, again, is a classical example. Suspected coronavirus incident on the ship. No confirmations. 5 countries refused, including Thailand, refused to dock the ship. Finally, Cambodia agreed to do that. And now again, see the disaster. They did the best thing possible, get the people off the ship. But then they did the worst thing possible, they let everybody go. Without a quarantine action on the people on the ship. So now those people are going everywhere in the world, and they will probably infect more people. So this is one of the ways that this virus has been spreading in a sort of uncontrolled ways, because governments themselves, even so-called clever governments or developed governments like Japan, have behaved as well or as poorly as a developing country like Cambodia. And then, of course, there's this 24-hour sensational news cycle on COVID-19, which makes everybody so scared that if you travel on the MRT in Bangkok, everybody's wearing a mask. And if you don't wear a mask, they look at you like this, as if to say, listen, you're the guy who's going to infect everyone. So that's how we have become conditioned now. So this is, and remember in China, what's happened? In China, they have actually locked down something like somewhere between 50 and 150 million people. And they're not allowing them to go back to work. So the Chinese holidays have been extended to the 2nd of Feb, then to the 10th of Feb, and even now today, from what we hear from our sources in China, workforce in China is around 10% levels. So it is really, China has still not yet started to work. If you look at the growth in trade, you can see that the trade wars and the tariff war has not really impacted the growth in trade. Trade has been growing every year. If you look at China's numbers, last year as an example, in the first half, Brazil and Australia had a problem with iron ore exports, and yet by the end of the year, China had imported 0.5% more iron ore than the previous year. In this, keep in mind that Brazil short shipped by 50 million tons. And each ton from Brazil is like 4 tons from Australia. So it is a big impact on the market, and yet the market went up to $38,000 a day on the 4th of September for the Cape-size market. In terms of coal imports, China was up at almost 300 million tons. And remember, this is despite the fact that in the month of December, China only allowed 2.8 million tons of coal to enter the country, which was equal to roughly 10% of the monthly average of the previous 11 months. So this number could have been higher by at least another 25 million tons if they'd allowed normal imports, but they didn't allow that. And still we had almost 300 million tons of coal import. Steel production was up to almost 1 billion tons. The amount that China increased their production in last year was almost equal to what the second largest producer in the world produces. So you can imagine how big China is. And when China slows down, like they have done because of the coronavirus, it has a disproportionate impact on the dry bulk market. In terms of steel inventory, it's roughly the same as last year, or rather as the previous year. In terms of steel exports, it's down by almost 10%. And in terms of steel consumption, it is up. So China is consuming a lot of steel for themselves, and mainly in the BRI, or the Belt and Road Initiative. So we think that China's growth is sustainable based on the numbers that we see. Now, this gives you the dry bulk trade in millions of tons. And you can see that according to Clarkson's, we should be growing by about 2.1% for this year in terms of absolute numbers of tons of cargo. If you see the same thing in ton miles, you can see that the growth rate then goes up to 2.7% instead of 2.1%. So this is a sort of a multiplier effect. If you see the same thing for minor bulk, that was for the whole market, but if you look at the minor bulk trade, you can see that minor bulk trade has been growing at anywhere between 3.25% and 5%. So this year, it's expected to grow by 3.2%. And at the same time, if you look at Clarkson's numbers again, they say that the smaller ships which do the minor bulk trade will grow by about 3%. So there is a positive gap between growth in demand and growth in supply for this year. These are the cargoes that we've been carrying. What is interesting to note and look at is that the absolute number of tons of cargoes carried by pressure shipping's identical fleet has actually grown quite substantially last year to almost 14 million tons. Coming to the supply side, if you look at the supply side, at the start of this year, there was something like 875 million deadweight tons of ships in the market. And the net growth rate was about 3.73%. or 33 million tons. If you look at the last portion on the right-hand side, you can see that the maximum growth in tonnage took place in the Panamax sector and then in the Capesize sector. That is basically in the bigger ships. And the smaller ships had the slowest growth rate. If you look at the forward order book as of the 1st of January, you can see that the total order book was 81.3 million tons, which is approximately 9.4% of the existing supply. If you break that down, you would see that the geared sector is only going to grow at 5.5% on the order book, but the gearless sector will be growing by 11.4%. So again, in the smaller size, the growth rate of ships, even in the forward order book, is lower. This slide gives you the averages that you could use, that the average growth rate for the last 20 years has been about 0.89 or 89 basis points over the world GDP growth rates to arrive at ton-mile growth rate. And if you want to look at a statistical rule of thumb, then it should be 1.15% or 115 basis points. If you look at the forward order book and then compare that with the older ships in the fleet, you would see that you have an order book of 9% all the way to 2023, and the percentage of current fleet over 20 years of age is at 7%. So more or less a replacement of the older ships. If you were to take the older ships all the way to 2023, then you would see that that would grow from 7% to 12%. So really speaking, the forward order book is acting like a replacement of the 20-year-old fleet. If you see the same thing in terms of the handy size and the Supras and Ultras, you see a much better picture. So what you see here is that you have a forward order book on the handy size of 4.6 million deadweight tons, or roughly 4% of the fleet. Existing 20-year-olds are 13% and extrapolated to 2023, 17%. So here you see that there will be an actual shrinkage of tonnage. So what will happen to the demand that these ships were servicing? That demand will flow to the right-hand side and come into the Supramax and the Ultramax level. Now, in the Supra and Ultra, what do you see? You see that the order book is 13.1 million deadweight tons, or roughly 6% of the existing order book, of the existing fleet. And the existing 20-year-olds are 9% and extrapolated to 2023, 14%. So here again, it looks like order book is less than the overage fleet. And therefore, we should be seeing again a slight shrinkage in this fleet. So demand is growing, fleet should shrink. It should result in much better numbers for us. Trade wars and tariffs, I think we've spoken about this quite often. It really makes no difference to the dry bulk sector. Coming to regulatory changes, there are two regulatory changes which are quite important and quite expensive. One is, of course, the ballast water management system, and the other is IMO 2020. Now, IMO 2020 has already taken place. As of 1st of January 2020, all ships in the world have to burn compliant fuel oil or fuel oil with a sulfur content less than 0.5%. Alternatively, if they burn the higher sulfur fuel oil, they need to put something called a scrubber plant on board. And you can see that the scrubber plant is massive and requires a lot of space and is very difficult to retrofit. So what does IMO 2020 really mean for a ship owner? It's just a question of choice. So should you install a scrubber system, or should you switch to low sulfur fuel oils? And if you do, then will you get your compliant fuel oil, and what will be the cost? So these are the factors that are there in front of the owners. Now, if you look at the actual amount of ships that have actually fitted scrubbers or will be fitting scrubbers, then for the smaller size ships, that is where we are located, it's about 5%, and 95% will be burning compliant oil. If you look at the bigger ships, it's 27% that have fitted or will be fitting scrubbers, and 73% will be burning compliant oil. So more or less, you could say the majority of ships in the world will be burning compliant fuel oil. Now, with the scrubbers, there are plenty of issues. You've got high maintenance cost, you have big operational issues, you have environmental risks when you fail, and when they work, scrubbers are great, and when they don't, they're terrible. And in any case, 85% of the scrubbers fitted in the world fleet are the open loop type of scrubbers, which basically discharge the dirty water into the sea. So you don't pollute the air, but you pollute the oceans. So it's not a great solution. But people have gone in for it because they think they'll make a lot of money. Now this is an actual incident of a scrubber failing, and you can see what a catastrophic failure can do to the ship. This is a very young ship. She's only She's only 2016 built, so only 3 years old when this incident happened in 2019. And she was out of commission for almost 3 months. Now, this is what a failure of a scrubber can do. So it is really a big problem when it does not work. In terms of pricing and availability of low sulfur fuel oil, today we have as much low sulfur fuel oil as you need. When the change over took place, prices spiked up, and we had low sulfur fuel oil being sold at between $700 and $750 per ton during the first half of January. The reason for that was not because there was not enough low sulfur fuel oil. It was because the small barges and tankers which would deliver the oil to the ships, which were not yet clean, they were still holding high sulfur fuel oil. Not enough capacity for that. There was a bottleneck. Once the bottleneck cleared, then this 750, and the difference was at that time for the high sulfur fuel oil, the prices were around the $350 mark. So there was a $400 differential at that time. That differential today is down to $200. And we think that by the end of the first quarter, this differential will come down to something like $50 to $100. The differential might actually disappear, because if all the barges and tankers, small tankers, switch over to clean fuel oil, there'll be nobody to supply the high sulfur fuel oil to the few ships that need it, and therefore there'll be a bottleneck the other way around. What we faced in the beginning of the first half of the January, they will face it after the first quarter of this year. So scrubbers, they may have looked as if it was a good deal for the first 1 month of this year. Now they're not looking so good, and I think once the differential drops to $100 or below, they start to lose money. So it becomes much more expensive to run a scrubber than to get the benefits from the differential in the price of oil. Pressure shipping is, as you know, part of the Getting to Zero coalition. So what is the objective of this Getting to Zero coalition? Getting to Zero coalition is a group of more than 100 companies and 18 different countries that have signed up, which says that by 2030, the objective is to have at least one commercially viable zero emission vessel on the water. And whilst we have ambitions to get that done by 2030, the reality is that we have one ship which is currently on the drawing board and will complete construction by 2024. It's an oil tanker which will have pure hydrogen usage in their engine. So zero emission vessel. It'll be ready and in the water by 2024. So though we have an ambition for 2030, it's going to be done much earlier than that. So those are the ships of the future. They will not burn any form of oil. They will burn hydrogen. Now, coming to impact of scrubbers or IMO 2020. So if you look at IMO 2020 and its impact, what does it show? It shows that if you look at 20-year-old ships, that is, ships that were built in the last decade of the last century. So ships built between 1990 and 2000, in those 10 years, those ships were built at a time when the average price of oil was around $19.7 a barrel. Not only that, if any of you are old enough to remember the Asian crisis, then you would know that in 1998, 1999, oil prices dropped to $8 a barrel. So when you have price of oil so low, the ship designers, all they went was for power and consumption, not for fuel economy. And so ships built in that decade were very big engined and overpowered ships. And therefore they consume a lot of oil. Oil prices from the turn of the century have averaged $62 a barrel, and in 2008 they went up to $147 a barrel, and at which point in time you have the famous Goldman Sachs report which said that this price is going to go to $200 a barrel. And I think that sort of woke up everybody, and very eco ships started to be designed in 2010. Those ships started delivering in 2011, 12, 13. So ships built before 2011 and 12 are all sort of over high consuming ships, high oil consuming ships. And in an environment of IMO 2020, where price of oil is higher than what it was before with high sulfur fuel oil or before IMO 2020, then those ships will become uneconomical to run. And we therefore expect that a large portion of the fleet that is 20 years or older will head for the recycling yards. So again, to recap, a small change in supply or supply of cargo, which is there on the left-hand side, made the rates drop from 13,300 to 3,400. And then a small change in the supply of ships pushed that same rate back up to 13,300 in another 2 months' time. So it tells us that supply-demand balance is almost perfect. Small change, 2% or so of reduced supply of cargo, rates came down sharply. Small change in supply of ships, about 2, 3, 4%, rates went back up very quickly. And so you can see clearly that this is a very finely balanced market. And we expect the same type of scenario to play out this year, with the first half of the year affected by COVID-19 and all the other factors that I gave you, and the second half to be very, very strong compared to the first half. So the question before the clients is simply this, that will you employ a scrubber-fitted ship, especially if you've seen this video, and this video went viral all over the shipping markets. So everybody's seen it in the shipping world. So will you employ such a ship? The question is then, second, will you employ a high fuel consuming ship, which is built 20 years or so older? Or will you employ a eco-compliant fuel burning ship? So I think the choice is fairly obvious, and we expect that this should benefit pressure shipping as we have a very young fleet and we have ships that are really, really eco. So to summarize, the last 3 years we've seen that supply-demand balance has been almost reached. And every small movement in supply or demand creates a big movement in price. During 19 and 20, we've seen that demand growth has been quite solid and supply has been sort of reduced. But in 19, we had very little scrapping, and therefore the supply grew higher than what we had anticipated at the start of the year. The order book to existing fleet ratio is so low, it has not been as low like this in the last 20 years. 2020 should be an interesting year if the recycling call that we are making works out, and the slow steaming call that we say will happen, and which we see already evidence of that in the market. We're already seeing that. When that happens, we should have a tightening of supply and therefore a improving of the market. Cost of capital has gone up. Future ships are being delivered which will be hydrogen burning, and therefore to order old-fashioned fuel-burning ships today makes little or no sense. And that is one of the reasons why the forward order book has been so tight and so controlled. The only problems that we see are, of course, geopolitical in nature, something like what Trump did by assassinating an Iranian general on Iraqi soil. So those type of events will create their own backlash. And the use of tariffs by Trump, because he feels he has succeeded with China, and next he wants to attack is the European Union. All these things are not good for the world economy, and therefore they will have a detrimental impact on shipping. So just to tell you what is our strategy is that we think that the second half of this year will be very strong, at which point in time we will try to lock in our ships on longer term contracts. For the smaller and slightly older ships, we will try to get a minimum 3-year contracts so that at the end of the contract, we can send those ships for recycling. For the younger and larger ships, we will try to get 5 to 7 to 10-year contracts and even 15-year contracts if we can, and lock them in on really long-term contracts, which will allow us very good steady cash flow coming in, and where we don't have to worry about the state of the market. This just gives you a snapshot of the fleet that we have. 36 ships, 8.25 years old, average size 44,000. And this is our forward order book. This shows you how many ships and what percentage of the fleet have been already locked in on long-term contracts, and what is the value of the contract. The value of the contract is on the top. The bars on the bottom represent the number of days in each of these years that has been locked in on long-term contracts. And if you look at market segmentation, in the fourth quarter, we beat the index by 11.5% on the Handysize, 12.6% on the Supramax, and 16.15% on the Ultramax. If you look at the whole year, the Handysize outperformed the index by 25%. The Supramax was on index, and the Ultramax were at about 7-8% above the index. So with that, I'll hand you over to Gautam, and he'll take you through the financials of the company.
Thank you. So in 2019, our total revenues for the year were 135 million, 135.3, down from 153.6 in previous year. For the fourth quarter, the revenues were 38.28 million, up from 34.28 million in the third quarter of 2019, although still below the 41.19 million total revenue figure in the fourth quarter of 2018. We incurred a loss for the full year of 7.25 million compared to a profit of 14.1 million in the previous year. However, for the fourth quarter of 2019, that was a return to profitability for us on a quarterly basis. The profit over there was 0.87 million compared to a loss of 0.96 million in the third quarter of last year. The loss is driven mainly by the lower average time charter income per ship per day, which for 2019 came in at 9,622 per day, compared to 11,063 in the previous year. For the quarter in itself, as you can see, the results were much better. The number was 10,628 per day, compared to 9,617 per day, so almost $1,000 more than the previous quarter compared to the third quarter. The average ship running cost per day for the full year was 4,778, more or less in line with our target of 4,750 per day. And that's driven by the fact we have more ships that went into dry dock in 2019. Also, of course, the ships are 1 year older. The fourth quarter figure specifically is 4,788. So more ships went into dry dock in the fourth quarter compared to the previous quarter, compared to the third quarter. Now, if you look at the time charter income per day, the difference between 2019 and 2018 is about $1,400 per day. Now, that is more or less every $1,000 a difference in time charter earning per day per ship translates to about $10 million in profitability. However, for 2019, it was a little bit worse than expected. Well, for two reasons. Number one, there were additional legal expenses that we incurred. So there was the extraordinary legal expenses in 2019. This is in relation to the Sainty arbitration for new buildings that we had placed several years ago. So there were considerable legal expenses. And also there was the Labor Protection Act implementation last year, so that required us to take a provision. These are the financial highlights. So as you can see at the top line, it shows our liquidity, so which is cash and cash equivalents as well as undrawn commitments. That figure for 31st December 2019 was 67 million compared to 74.79 million in the previous year. The actual cash on balance sheet, so excluding any undrawn loans, was 39 million compared to 56 million the previous year. The cash went down also because we had prepaid some loans. So if you look at a long-term loan figure, that is 237 million for as of 31st December 2019 compared to 278 million and 31st December 2018. The advances to Sainty figure, that remains the same, so it's still 64 million as of 31st December 2019 compared to 31st December 2018. The arbitration continues, however, there is no result, so that's why that figure hasn't changed. The total fixed assets or ships, the total assets related to ships, that figure is 664 million.89 compared to 689.37 million. And that reduction is mainly because of depreciation. The total number of ships that we have has remained the same at 36. The debenture figure, as it shows over here, it says it's 182.82 million. However, that does not take into account the cross-currency swap that we have on the debentures. When you take that into account, the exposure that we have is actually about 154 million. So it shows that there is an increase, but there is actually no increase when you take into account the cross-currency swap. Total shareholders' equity is down from 391 million to 383 million as a result of the loss that we incurred. Book value per share 7.41, down from 8.14 on the previous year. Next slide. This slide shows a very detailed breakdown of the average operating costs of our ship, and these costs are evenly spread over 365 days. So the total cost for 2019 was, as I said in a previous slide, is 4778, up from 4621 as we had more ships going into dry dock, and this was part of a plan because we needed to prepare ships for meeting the IMO 2020 regulations in relation to burning of low sulfur fuel oil. So we front-loaded our dry dock, so therefore that's reflected over there in slightly higher expenses. There's a slight increase in insurance, very marginal. Stores and spares are actually down for the full year. This miscellaneous expenses is the additional work that we have done mainly for preparation and for IMO 2020 regulations. The target that we have for 2020 is 4750 per day. This chart shows our operating cost compared to the industry average. So this figure excludes dry dock and special survey. So therefore, when you exclude that, our total operating cost as measured by the industry works out to 4142 per day compared to the industry average of 4841 per day. Now, if you remember, every $100 of additional cost works out to about $1 million on our bottom line. So we have a $700 advantage per day. So this gives us quite a competitive advantage. This shows the evolution of, first of all, if you look at the top line, it shows the average age of our fleet and the evolution of that over the last 30 years. So from 1995 to about 2011, the average age of our fleet was about 15 years. Thereafter, we ordered a number of ships. We scrapped our old ships. The average age went down. It reached its bottom in 2016. It's 5.8. Now, our fleet hasn't really changed, and so therefore the average age has been going up by 1 year. So currently it's 8.3 years. The line below that shows the time charter rate, the average time charter rate of our fleet. Oh, sorry, so that line is that's the deadweight line. So this shows the average size of our fleet, and you will note in the past we were mainly in the handy size sector. However, from 2011, 12, 13, we have started to order bigger ships, and therefore the average deadweight of our ships has gone up, and it's currently 44,000. Below that is the green line is the average time charter rate. So 1995 was a very strong market. The rate at that time, what seems like quite a low rate right now, but that was a very high rate. That was 7,300. Then we had the Asian financial crisis. Rates went down to 4,800. And then you started to gradually move up. China entered the WTO. There was a surge in buying. There was a super cycle there. Average rates went up to, in 2005, they went up to 14,000. And in 2008 up to even 16,000, which is the highest average rate that we have had as a company. Well, what happened following this super cycle is ship owners plowed their money, their investments, their profits back into ordering more ships. The order book at about 2008, 2009 was 50% of the fleet compared to about 9%, as Khaled showed you in a previous slide. And all of those ships started to get delivered from 2008, 9, 10, all the way to 2015, 16. And this supply overhang caused rates to decline gradually, as you can see. Now, fortunately, the oversupply situation has reduced, and therefore we are starting to see a reversal of that. So we're starting to see a gradual increase in rates. The operating cost, there's the line below that is our operating cost. And so you'll see in 1996, it was 3,000, then it declined to 2,500 when markets were low. And then there was a slight increase over time. Our ships started to get older, so operating costs were higher. And then we started to order new ships, albeit bigger ships. Bigger ships are slightly more expensive to operate than the smaller ships. So there has been a decline compared to our operating cost in 2008. However, it is still, it's close to, I would say, it's moving up now, as expected. This graph shows the evolution of our debt and debt to equity ratio. So going back in time, in 1995, we had the highest level, our total debt was about 226 million, and it went up to 257 around the Asian financial crisis. Debt to equity ratio was also quite a high level then. It was 3.8. We came out of that, our debt reduced down to 0.9 and then eventually down to 0 as markets improved. We paid off all our debt. And then gradually we embarked on a program to order new ships, following which we took on more debt, and that's reflected. So over here, so in 2015, 16 is when we had a peak in debt, and also there was a mini peak in the debt to equity ratio, which is now again gradually reducing. Our intention is to continue to reduce it over time. Our target is to have a debt to equity ratio of about 0.7 to 0.8. This shows the debt to EBITDA ratio over time. This was when our fleet was old, the absolute debt levels on the ships was relatively lower, because the total debt that you have for each ship is a function of the vessel's age. Now, as our fleet became younger, the absolute debt levels increased substantially, and that's what's happening over here. So you may have the same EBITDA. You can have a 20-year-old ship and a 5-year-old ship, and they may have the same EBITDA, but the debt levels that they have are substantially different because of the age, and that's the reason why the debt to EBITDA ratio went up quite substantially in 2015-16. All our ships are quite young, and whereas the EBITDA was the same as some of the older ships. However, that is coming down. This graph shows the cash operating profit and the operating P&L. So you will see that the cash operating profit as such, or in our history, there have been very few occasions where we have had a cash operating loss as such, which is around 2015 and 16. When you take into account, when you deduct depreciation, then of course the P&L figure goes below zero on more occasions. The lowest, of course, was in 2015-16. It was about minus 38 and minus 37 million, which is the worst time of the market. This shows the evolution of net profit and cash profit, which is essentially cash profit meaning we are adding back depreciation. So when you add back depreciation for 2019, it was positive 23 million, whereas the accounting profit or loss was negative 7. This shows our dividends over time. We stopped paying dividends in 2014 for obvious reasons. Market was low. However, it is our intention to restart dividends over time. Our policy is to pay not less than 25% of net profit as dividends. This is just a summary of the overall financial profile. I think you've seen much of this before. I would just emphasize perhaps that if you look at the number of vessels over time, it appears that our vessels fleet has decreased, but actually it hasn't. When you look at it in terms of deadweight, our total deadweight has actually increased because, yes, we have fewer ships, but we've got bigger ships. So the total deadweight ton capacity of our fleet, cargo carrying capacity of our fleet has actually increased over time. Yeah, so this is just a summary of some of the awards that either Precious Shipping or a Precious Shipping subsidiary Great Circle or even a ship have won. So in 2018, Precious Shipping was a finalist for Ship Owner of the Year in a award ceremony by Sea Trade, also by Lloyd's List, and also by the International Bulk Journal. Our ship management subsidiary was finalist for Ship Manager of the Year in an award ceremony by Sea Trade and also Lloyd's List. One of our ships, our cement carrier Oppday Year End, was finalist for Bulk Ship of the Year in an International Bulk Journal award ceremony. These are just some more awards. Last year, the PSL board was among 10 finalists for Board of the Year in an award instituted by the Thai Institute of Directors and the Stock Exchange of Thailand in the category for companies with market cap below 30,000 million baht. Here are some more awards that we have won over time. Corporate governance. We take corporate governance very seriously. The company has received an excellent rating in terms of its corporate governance for 10 consecutive years, so from 2010 to 2019. Over the years, we've won several other corporate governance awards. I won't go over those. In the middle of last year, Marine Money, which is a New York-based shipping finance publication, ranked us as number 16 of 97 globally listed shipping companies in terms of overall financial performance. Yeah, and so within the dry bulk space, we were actually ranked number 2 of 19 listed dry bulk companies. And the reason for that is because we, as I explained earlier, we have a competitive advantage in terms of our technical costs. We keep those very low. As Khalid said, we managed to outperform on the commercial side. We've consistently outperformed the indexes on the commercial side. That has helped us outperform our peers, our listed peers, globally. For the most part, we're number 2. In between 2005 and 2012, we were actually ranked among the top 10 shipping companies globally in terms of financial performance consistently. And after that, with the downturn of the dry bulk market, our ranking, of course, started to move up. But it's moving in the right direction now. This infographic shows our total return to shareholders from the time of our IPO in 1993 until today. If someone had invested at the time of the IPO, they would have received 10.54 times of their initial investment by today. This is another data point, another slide in relation to investment. So it just shows the value of investment over various points of time. So if one were to have invested in PSL stock in the year 2000, right after the Asian financial crisis, the return would have been about 48 times. Thank you.
Great. So we are open the floor for questions. Whilst we're waiting for questions from the floor, we have 2 from the net. So maybe I'll just answer those first. So the first question is, how did COVID-19 affect the shipping industry now and in the future? So in terms of the immediate impact, you can see quite clearly the index has come down to one of the lowest levels that we have seen. So that's an immediate impact. And in the future, I think it will reverse. As I said, we hope that the second half of the year will be much stronger than the first half. The second question then is, what is the ship scrapping rate for Q1 2020 so far? We just saw a report the other day in the press. I think it was dated 14th of this month or the 17th of this month. It said that to date, that is for the first 40 days of 44 days of the year, 2.4 million deadweight tons of ships had been scrapped. So from that point of view, it looks quite clear that scrapping rates are at a much faster speed today than they were last year. Last year was 8.23 million for the whole year. And for the first 44 days, we've already got 2.4 million deadweight tons already scrapped. So that's the answer to the second question from the net. So now we are open for questions from the floor.
Could you kindly discuss some of the routes that you're taking? Like, for example, if you're going to China, if the ships are banned from other ports and for PSL's port?
Okay, so normally first of all, we can't refuse to go to China. So under the contracts and then the legal position is that a port is considered safe so long as you can enter it, do your work there, either load or discharge the cargo, and leave safely, employing good seamanship. If you can do that, then it's considered a safe port. Now let's say that the authority in China at that specific port declares that this port is no longer safe, we have a virus outbreak. Then in that case, you don't have to go to that port. But otherwise, your legal obligation today is that you are forced to go there. Now, once you go to a Chinese port, what do the other ports do? They say that if you come before 14 days after the last date of your presence in China, then you have to wait till the end of the 14th day. Then they'll come and examine the people on board. And then they will. So if you end up with a ship in China, what do you normally try to do? You try to take a cargo out of Australia. That means that requires you to ballast or go in an empty condition for almost 15, 16 days. So you would cover the waiting period and there would be no real wait except an examination on arrival. And if everybody is safe, no problems at all.
Could you kindly discuss if there's, for example, the cape size? I heard that the TC rates are very low or negative, so I'm not sure if there is competition from the capes for the smaller ships, although they carry different cargoes.
Okay, so you answered the second part of the question correctly, that the types of cargoes carried by capes and carried by other ships is quite different. So they really can't compete on cargoes. But you're right, the index for the capes has come down quite sharply and actually is negative, despite the fact that the average time charter rate based on which the index is created is positive. So this is a flaw in the index creator, that is the Baltic Exchange, and therefore the Singapore Exchange, which owns the Baltic Exchange. I think both of them are really silly. They've really tried to make the index much more speculative than it needs to be. And in that desire to make it speculative so that people will gamble on it and then they will make some commissions on it, they have gone and redone the way you calculate the index. Now they're saying, oh, we made a mistake. This is not the right way of calculating the index. We are going to start a new calculation for the Cape Size Index. What I'll do, Bunprasit, is I will send you an email which will contain an article from Lloyd's List which tries to explain this. But even that, when I read that article, I still don't understand. But I will send it to you so that you get some idea of what they have done and how they're trying to correct it now. So it's really, the index is understated today. That's what my impression is, because if you recalibrate the Cape Size Index, it'll go into positive territory. And if it does, then the BDI will go up, should go up from where it is now. Right now, I think it's undershot the bottom because of the way they calculate the Cape Index. And that I think is wrong, and they're going to correct it.
Could you kindly discuss about the front load dry dock for our case, if there and the time that it will take to dry dock given the current situation in China and the docks, for example?
Right. So you see, right now we have a problem. Okay, we have got a few docks to be done, but when we go into a dry dock, for example, we need to fit a ballast water treatment system. And we need labor at the dock to do the work. Right now, the docks are saying you can come, but your equipment that you need for the ballast water treatment system comes from another state, another province. And today in China, you cannot cross provinces. So equipment cannot move from one province to another province, not yet. Once they open up and the COVID-19 has come down, they will start to open up the provinces to inter-province trade. Right now, it's not allowed. So even if we go to dock, there's no labor to really handle the ship. The docking will be very, very delayed. 2, the equipment that we need to fit at the dock will not be available. So what have we done? We have gone and approached our classification societies and told them, listen, we have a big problem, and they understand. So they've already given us a 3-month extension of the dry dock date. Then we went to the US Coast Guard and told them that, listen guys, we promised you that we would fit a ballast water treatment system by the end of Q1 of this year on this ship. But we have a problem in China now and we can't do it. So they say, okay, we give you 2 years more. For next 2 years, you don't have to worry. You can come to America without ballast water treatment system. We will accept your ship. Once the situation is normalized, you can please go back to China and fit the... So that's what's happening right now. So we are not really docking those ships. We're just delaying the dock.
Could you discuss about possible impairments of ships and at what point that this will need to be seriously considered?
Right. Now, impairment of ships, when do you impair an asset? You impair an asset, one case where you're holding it for sale. So let's say we decide we want to sell 5 ships and we look at the market and we see what is the market price of those ships. Let's say that the book value of the ships is $10 million for the 5 ships and the market price is only $5 million. Then the auditors will ask you to take an impairment charge right in the beginning of the year of $5 million. Okay? Now this is for an asset held for sale. When an asset is not held for sale, but it's held for long-term reasons, then what do? You then try and look at the forward cash flows of the ship and see on a cyclical basis that whether this will equal the current value of the ship that you have. And if it does, then there's no impairment. And if there is, then you have to take an impairment. So we do this test quite often with our auditors, and so far the auditors have not seen any reason to impair the assets. And I think we have actually run out of time. I'm getting signals from there to say that we have to wrap up the session. So anyway, thank you so much. Sawasdee krap.